Hello, welcome to Strictly Money. I'm Saijal here at the News Forum, where all voices matter. Let me ask you a question. How do you know that the financial advice you're getting actually makes sense? You're bound to get a lot of financial tips. Maybe it's from a social media influencer, maybe it's from your best friend, but some tips may not suit your situation. In fact, often the best advice you can get is it depends. Jason Heath is a fee only financial planner with Objective Financial Partners, and he joins me now to talk about the most common myths and misconceptions when it comes to your money. Jason, great to see you.
Thanks, Saijal.
Maybe let's first talk about the value of advice because how do people really discern between all the information out there? I think the biggest myth is that just because you like someone or someone you know has benefited from advice that they've heard, it doesn't mean that it's right for you.
Yeah. Yeah, it's tough. I see it all the time where I come across people who say, oh, I've got this great financial advisor and we'll sort of dig beneath the surface with their investments or insurance or whatever the case may be. And there's things that stick out that maybe aren't necessarily in their best interest. And I think part of the challenge is consumers don't know what they're looking for in a lot of cases. They do judge people, based in large part based on the relationship. And they may not know, what questions to ask. And the financial industry in Canada is kind of tricky because there's a lot of conflicts of interest out there.
Do you think that they just need to do certain types of homework? I mean, I know my message is, look, you don't need to know how to invest. You need
Yeah.
to know, but you need to know enough to know that you're getting your needs met.
Yeah. I, I honestly, I think knowing the questions to ask, educating yourself to be able to ask questions about your financial situation, your investments, your taxes, your insurance, whatever it is really important. And even if you don't understand all the ins and outs, something as simple, to be honest, as asking an investment advisor how you pay your fees or how much your fees are can be really eye-opening because I've seen people that haven't got good answers or
Mm.
seen uncomfortable responses from their advisor, and it's enough to throw them off a little bit that boy, this person that I trusted and I really like, maybe isn't giving me the whole story. So sometimes simple things like that are red flags, but certainly educating yourself is the most empowering thing you can do in personal finance.
Yeah, absolutely. And I think, Jason, I always make the point that it is your money and you have the right to ask those questions and make sure that your answers are met. Let's talk about one of the myths that you have talked about and tried to dispel. And this is about dividend stocks.
Yeah.
It's not for everyone. Tell us why.
Yeah, so I think there's a bit of a myth out there that dividend stocks are somehow better investments than other types of stocks, or that investors should focus on dividends. And just for everyone out there, a dividend is a distribution of the profit that a company earns. And you can have one company that is very established, that doesn't have a lot of growth potential, and the board of directors decides that their profit will be paid out on a quarterly basis to investors as a dividend. And you can have another company that is equally as profitable, but it's in a much higher growth industry. They're able to reinvest the profit into growing the company and therefore growing the share price. And instead of paying the dividend out to investors, they reinvest. I mean, a good example might be a company like Apple, for example, very profitable company. The dividend is only about a 0.5% per year that's paid to investors because they're in growth mode. They're reinvesting the profit into growing the stock price, and they've been successful at doing it. So to take a company and say, oh, geez, Apple's paying a low dividend, maybe I'm going to avoid a company like that, would have hurt investors over the last number of years if they used dividends as their sole criteria for investing.
Yeah, it really does depend on what your goal is. Are you looking for growth or are you looking for maybe steady income and you're willing to give up some of the upside in the growth?
Yeah. And I think the other thing is, even if somebody is looking for income, you can kind of create your own dividend to a certain extent by selling shares of a company that pays a lower dividend. And depending on where you own your investments and depending on your income, capital gains, selling
Mhm.
an investment for a profit can be taxed.
Welcome back. We've been talking about dividend stocks and the myths and misconceptions around them. Jason, for those who only focus on dividend stocks, is there a risk that they might not be as diversified as they should be?
For sure. I think that's a big challenge, particularly in the Canadian market. The biggest dividend paying stocks are in the banking, utility, and telecom sectors. And if you were to look at a more diversified stock market like the S&P 500, for example, those three sectors are less than one quarter of the S&P 500. So investors could be significantly overweighting certain sectors, ignoring, technology and healthcare and consumer stocks and things like that that could create a more diversified portfolio. And look, there's worse sectors or stocks that you could overweight than Canadian banks, of course. But for perspective, over the last 5 years, the biggest Canadian bank, Royal Bank, has returned about 7.5% per year, sort of in line with the Toronto Stock Exchange. But the S&P 500 has done about 11% over the last 5 years, all in with dividends. Again, after a brutal year in 2022 as well.
Okay, let's talk about the next myth. Stocks are risky. Now, I
Yeah.
hear this one a lot because I run an online financial program. This is probably the one of the biggest concerns that women talk to me about.
Yeah. Yeah. I think stocks are risky depending on the time horizon you're looking at. And they can be more or less risky. And just on like a 1 year period, as an example, over the last 100 years, the S&P 500 has lost money about 25% of the time. If you look at day to day, the S&P 500 goes down about 44% of the time, or has gone down 44% of the time over the last 100 years. So day to day, stocks can be very risky. But over a 5 year period, the S&P 500 has gone up about 88% of the time.
Yeah.
And especially if you have a more diversified portfolio that includes Canadian stocks, international stocks, bonds, the likelihood of losing money over a medium term time horizon is very low.
Yeah, and let's not forget, you have a lot of variety of stocks. You could have, the small cap,
Hmm.
growth stocks, and then you have ones that are established. So risk varies.
That's just it. I mean, if you put everything into a junior mining stock, that's a risky portfolio. If you have exposure to an international exchange traded fund that owns 10,000 different stocks, you reduce your risk significantly. So, risk, I find, is all relative. And I think it's also very important to recognize the risk of your investments not growing enough to fund your retirement or not generating enough
Yeah.
of a return to keep
Yeah.
up with inflation once you are retired.
Yeah, I always say it's hard to actually lose money if you follow simple rules, and that is take a longer term approach,
Hmm.
diversify your portfolio, and the fact that you just made Jason not investing is risky, especially because there's this depletion of purchasing power.
For sure. Yeah.
Um, y- the other point I want to make too, and get your thoughts on this, is that there's a lot of focus on investing when it comes to this fear around losing money. My experience, and I don't know if this is your experience, is that people will lose more money by not being protected from life events.
Yeah.
Would you agree?
Well, I would agree. It's interesting. There was I wrote an article a couple years ago about uh, regret in retirement. And it was based on a study that was done where they had asked a whole bunch of retirees what were the things they regretted when they look back over their financial life. And interestingly, it wasn't saving enough. It wasn't, that they didn't invest aggressively enough, although those are important things. But the main regrets people had related to life events that came up, death, not having proper life insurance in place for a breadwinner, disability, or a health issue that impeded
Yeah.
their ability to work and earn an income. Death, disability, and divorce, I mean, are sort of the three Ds that can derail, if you will, a financial plan. So even though some of these other ancillary things like investing and diversification and tax reduction are important, there are other risks that are important to mitigate. And you can do it with insurance to a certain extent. Divorce, I mean, that's a whole other thing. There's no
Yeah.
divorce insurance, but death and disability for sure.
Okay, a lot more unfolds. We'll be right back after this short commercial break. Welcome back. Jason, let's talk about myth number 3, or misconceptions. Always max out your RRSP. And your thought is, if your income is below 50,000, you probably shouldn't contribute to one. Let's hear about this.
Yeah. So, generally speaking, I think if your income is below $50,000, you're probably in the lowest tax bracket. Depends on the other tax deductions, which province or territory you live into, or which province or territory you live in. If you can't contribute money to an RSP at a higher tax rate than you're going to withdraw it, then you probably should think twice about contributing to an RSP. So again, if you're in the lowest tax bracket, your income's under $50,000, you're probably going to pull the money out in the lowest tax bracket, or potentially even a higher tax rate in retirement. And that can make contributing to an RSP disadvantageous, especially because seniors may be entitled to, means tested benefits that RSP withdrawals reduce. So there's a lot of low income seniors, I think, who could put money into their RSP when they're in the lowest tax bracket and potentially pay more tax on the withdrawal and be worse off financially.
And the tax deduction, I mean, you're not getting a massive benefit if you're in a lower tax bracket. Is that part of it?
Yeah, I mean, the sort of quick math is if you're putting money in the lowest tax bracket, which is roughly 20% across the country. If you're saving 20% on your contribution, and in the future that money grows and you pull it out and you pay a 20% tax rate as well, you'd be in an identical situation if you contributed to a TFSA. In other words, it's kind of a wash between contributing to your RSP and contributing to your TFSA in terms of what the after-tax withdrawal would be in the future. But again, the drawback or the risk is that some seniors, depending on their spouse's income, for example, might be in a higher tax bracket in retirement, or they might lose government benefits. So in a lot of cases, I think if your income is below $50,000, you're better off contributing to a TFSA.
I was just going to say the
repaying
TFSA would
debt.
probably make more sense.
I think that the one sort of asterisk is if you have a company matching contribution, that's free money. I'd always take advantage of that.
Yeah, for sure. Let me ask you this then. What about the fact that if you do contribute, and I agree with you, Jason, if you're in that situation, look at the TFSA first. The RRSP may be secondary, but I guess my question is, what about the benefit of the money growing tax-free and you taking advantage of the power of compounding? Does that sort of negate, do you think, the fact that, when you do pull that money out, all of it's taxable?
That's part of it, that when you contribute to an RSP, you get a tax deduction and you have tax savings, which is great. As it grows, and you take withdrawals in the future, the withdrawals are fully taxable. So you get, hit on the back end. And again, I see a lot of people who contributed at low tax rates and pay a higher tax rate on withdrawal, or, heaven forbid, they die at a young age. Your RSP is fully taxable all in 1 year on your tax return. So it can be a bit of a, disadvantage. The introduction of the TFSAs about 15 years ago now, 14 years ago now, I think really is a game changer. It's advantageous for low income savers. It's advantageous
Yeah.
for high income savers. There's a lot of people in the middle who, might not be sure, do I invest? Where do I invest? Do I pay down debt? But certainly if you're at the extremes, relatively low income or relatively high income, that makes a big difference. Lower income TFSA, higher income RSP, middle income, it depends.
Yeah. We only have 45 seconds left, Jason, before the commercial break. When is it better off to just put your money in a non-registered account? Because there are some tax benefits, like you get, the dividend tax credit.
Yeah, no, good question. I think if you have RSP or TFSA room, it generally makes sense to take advantage of that. If your income is
Absolutely.
below $50,000, I would max out your TFSA before considering non-registered or RSP investing. If you have a low income and your TFSA is maxed out, which cumulative TFSA contributions are currently $88,000, then maybe I would consider non-registered investing. But for most people, I think that's sort of a last resort. Take
Okay.
advantage of the tax preferred structures.
Okay. We'll take another break. We'll be right back. Welcome back. Our guest is Jason Heath. Jason, the last myth that you wrote about, and this is in a Financial Post article that you contributed to recently, CPP, that CPP will not be there, so apply early. I hear this a lot. It's probably one of the most controversial, I think, topics that you and I just discussed is out there.
Yeah, no, I would agree. I think a lot of Canadian financial planning, retirement planning, tax planning advice is influenced by US myths or US influences, I suppose. I mean, the most recent annual report for the Social Security found that funds may run short by 2034 and
Mhm.
require a 20% reduction in the US Social Security unless Congress intervenes. Sometimes I think that influences people's thinking about the Canadian, retirement pension (CPP). The Chief Actuary of Canada does every 3 years an actuarial assessment of the CPP based on contributions, pensioners, immigration, inflation, rates of return, whatever. And they have found most recently in 2019, 2020 that the CPP should be a viable pension for the next 75 years. So I'm pretty confident it's going to be there for myself, let alone people who are already retired. So I really think that is a myth that the CPP is not going to be there.
Yeah, so let's talk about that second piece then. That a lot of people, at least that I know, they're anxious to take the CPP early. As soon as they turn 60, they want to take
Yeah.
it. Let's go through that analysis
Yeah.
and why it might not make sense.
So, I mean, with most pensions, whether it's a workplace pension or a government pension like the CPP or old age security, if you start the pension earlier, you get less. If you start the pension later, you get more. CPP is the same. You can start it anywhere between age 60 and age 70. Statistically, for what it's worth, about a third of applicants apply at 60, about a third apply at 65, and virtually nobody, under 5%, apply at age 70. And frankly, I think that most people should actually wait to start their CPP as late as 70, even though almost nobody does.
Yeah, well, because we're also living longer. And if I'm correct, how much is it boosted? How much more do you get beyond
So
65?
if
It's
you
quite a bit.
defer your pension after age 65, it increases by 8.4%
Yeah.
per year, plus an inflation adjustment. So in a 2% inflation environment, acknowledging that we're not there right now, I mean, it was a 6% inflation adjustment last year. It's over a 10% increase in your pension for each year you defer. And basically the way that it works is if you start later, there's a break even, there's a crossover point if you live long enough. And generally, even if you adjust for the time value of money, If someone says, well, if I start at 65, I could invest it earlier and I could make more money, even if we use a reasonable discount rate, if you live into your mid 80s, you will be better off deferring your CPP to age 70. And the average 65-year-old has a life expectancy of age 90. Once you make it to 65 in the first place, you've got about a 25-year life expectancy.
Yeah, and Jason, you hit home a point. 8.4%. That's not an easy return for someone to make on their own in the market,
Yeah.
and this is pretty much guaranteed. And so you have
Well,
to,
sure.
you do have to think about that. We only have 30 seconds until the end of
Yeah.
the show. When should someone take it early?
I think with CPP, the big thing is life expectancy. You know, if you have good genes and you're in good health, I would strongly consider deferring your CPP pension. If you can hedge your bets and start your old age security pension at 65 and your CPP at age 70, CPP has a bigger annual increase for each year that you defer it. If you've got other existing defined benefit pension plans from work, maybe you're well protected in terms of your longevity protection. And conservative investors, I think, would be better off deferring their CPP over more aggressive ones.
Jason, always a pleasure to have you on. Thanks so much.
Thanks for having me, Saijal.
Jason Heath of Objective Financial Partners. Well, that wraps up this edition of Strictly Money. You can catch previous episodes of the show on thenewsforum.ca. Stay well, stay wise, and stay wealthy. Thanks for watching.